Welcome back to Iron Financial, the channel where we help you forge a stronger portfolio and cut right through all that market weakness. I'm your lead analyst. Today, we are putting on the hard hats, we're grabbing the blueprints, and we are going to inspect one of Europe's banking giants, BBVA. Now, they just dropped an earnings report that on the surface looks like an absolute financial fortress. I mean, impenetrable, powerful, just churning out gold. You've got record profits, massive shareholder payouts, and incredibly aggressive growth. It looks like the perfect picture. But the market reacted by knocking a full 7% off the stock price, and that just doesn't add up. So the question we have to answer today is this: has BBVA truly built a fortress of sustainable profit, or are we looking at a beautiful facade that's been built on a foundation of sand?
And that's the whole game right there, isn't it? I'm your market skeptic, and look, when I see a company screaming from the rooftops about record profits while its stock is taking a nosedive, my alarm bells start ringing loud and clear. The market is supposed to be forward-looking, right? So if the present looks this good, then the market must be seeing something pretty ugly coming down the pipeline. The headlines are pure hype, but that stock chart is telling a completely different story. Our job today is to figure out if the market is just overreacting or if it has spotted a serious crack in the armor that the rest of us are missing. This is the central conflict we're going to deconstruct piece by piece.
Exactly. And to do that, we have to be methodical. Okay, let's get into this. Before we go searching for any cracks, we have to respect the structure itself. We are going to build the bull case first. We're going to lay down the heavy foundation of their argument with the raw, undeniable numbers. We'll start with those headline figures that make this company look like an absolute titan of the industry. You see, we need to understand the source of all this strength before we can even begin to test its durability.
So let's start with the cornerstone of the entire structure, 10.5 billion euros. Let that sink in. That is the net attributable profit BBVA generated in 2025. Now remember, this isn't revenue, which is just the total money coming in the door. No, this is the bottom line, the pure unadulterated cash profit after every single expense, tax, and provision has been paid out. It is, by all accounts, the highest profit in the company's entire history. A number this massive isn't just a data point. It's a statement of raw, unadulterated earning power. It's the kind of number that's supposed to make investors feel secure. You know, like they're backing a champion that is firing on all cylinders. This right here is the very bedrock of the bull case.
But a fortress can't just be strong. It has to be expanding its territory. And this right here is where the engine of BBVA's growth becomes crystal clear. A 16.2% increase in lending activity. Look, this is not some sleepy, mature bank just sitting on its assets and collecting interest. No, this is an institution that is aggressively pushing out capital, writing new loans for families, for small and medium businesses, for huge corporations. This is the fuel that drives the entire revenue machine. More lending means more net interest income, and that is the lifeblood of any bank. So this figure tells us that the record profit wasn't some kind of fluke or a one-off accounting trick. It was driven by a powerful and rapidly expanding core business. They are actively taking ground.
So how are they expanding so fast? Well, they're bringing in new blood. And what's really fascinating about this slide is the sheer scale of their customer acquisition. We're talking 11.5 million new customers in a single year. Just look at that trend line. It's a steady, powerful climb. This is what aggressive market penetration looks like. But more importantly, check out that bubble on the side. 66% of these new customers were brought in through digital channels. Now this tells a crucial story. BBVA isn't just some old brick-and-mortar bank. It's a modern financial institution that clearly understands how to attract the next generation of clients and do it efficiently. This is a sign of a healthy, adaptable business that is winning the battle for market share.
Okay, so let's put it all together. This slide does a brilliant job of illustrating the entire bull case in just one snapshot. Focus on these key metrics with me. You've got the lending activity growth we just mentioned, over 16%. Now look at the return on tangible equity, or ROTE, sitting at a huge 19.3%. For a major bank, anything in the mid-teens is considered excellent. Getting over 19% is simply best in class. It means for every single euro of shareholder capital that's invested in the bank's core assets, they're generating almost 20 cents of pure profit. Think of it as a measure of raw profitability. Then you look at the efficiency ratio, 38.8%. This is a measure of how lean the operation is. So for every euro of revenue they bring in, it only costs them about 39 cents to run the business. That is incredibly lean for a bank of this size. Growth, profitability, efficiency. Every single key metric here paints a picture of a company that is operating at absolute peak performance.
An impressive fortress, I have to admit. But every single fortress has a power source, right? An engine room where all the real heavy lifting gets done. For BBVA, that engine room is located south of the border. To truly understand the power behind these numbers, we have to leave Europe and drill down deep into their operations in Mexico, which frankly has become the undisputed core of BBVA's entire global strategy. So let's open the door to that engine room and see what's really powering this machine.
And here it is, undeniable proof. This donut chart tells you almost everything you need to know about where BBVA's power is really coming from. Just look at that massive light blue slice. Mexico. It's contributing 5.26 billion euros, or 45.4% of the entire group's net attributable profit. Think about that. That's nearly half of the company's total earnings coming from a single country. Spain, its home market, is a very distant second. So you see, this isn't just a component of their business, it is their business. Mexico is the high-octane fuel that's powering the entire BBVA group, allowing them to post those record numbers and fund those massive shareholder returns we're about to get to.
And this engine isn't just large, it's growing at a formidable pace. Net interest income, which is a bank's core revenue, the spread between what it pays for deposits and what it earns on loans, well, that grew by 7.5% in Mexico last year. In an environment of pretty significant economic uncertainty, posting that kind of steady, solid growth on such a massive base is a true testament to the strength and leadership position they hold in that market. It just reinforces the idea that this isn't some one-time surge, but a sustainable, powerful trend. The engine room is not only running, it's getting stronger every year.
Okay, so we have a fortress that's built on record profits, and it's powered by an incredible engine down in Mexico. But what's the point of all that power if it doesn't translate into tangible returns for the people who actually own the company, the shareholders? Well, this brings us to the third, and you could argue the most compelling pillar of the bull case. BBVA isn't just a profit machine. It has become a shareholder payout machine, absolutely showering investors with an unprecedented amount of capital.
Just look at the story this bar chart tells. After a bit of a dip back in 2020, you see a relentless, steep climb in the cash dividend per share. It culminates in 2025 with 0.92 per share. That's a staggering 31% increase compared to the previous year. As the CEO himself said, it is by far the highest dividend in the company's history. Now, this isn't just a return of capital, it's a powerful signal for management. It's a statement of extreme confidence in the company's future earnings power and its stability. They clearly believe the fortress is strong enough to send this much cash over the walls to its owners.
But wait, the dividend is only part of the story. When you combine the 5.25 billion euro cash dividend with the nearly 4 billion euro extraordinary share buyback program, you get a colossal total shareholder distribution of over 9.2 billion euros. A buyback, of course, is another way to return cash to shareholders by reducing the total number of shares out there, which in turn increases the value and the earnings per share for all the remaining stock. This dual-barreled approach, a record dividend and a massive buyback, is the ultimate bull argument. The fortress is so profitable it can afford to give away an amount of cash that is nearly its entire annual profit.
And we can cap off this whole bull case with this powerful quote directly from the CEO, Onur Genç. BBVA is at its best moment. This is not cautious optimism, folks. This is a declaration of victory. He's summarizing the unassailable strength that we've just laid out. Record profits, outstanding growth, and unprecedented shareholder remuneration. From the inside, the view is absolutely perfect. The fortress seems impenetrable. And that, right there, is the complete bull case. It's strong, it's compelling, and it's built on a mountain of cash.
It's a beautiful blueprint, I'll give you that. But, you know, every fortress looks strong from a distance. The real test comes when you get up close. You start tapping on the walls, checking the foundation. So it's time to apply some pressure. The market sold off 7% for a reason, and it certainly wasn't because of the CEO's victory lap. It saw something else. So now, let's take on the role of the skeptic and go searching for the cracks in this seemingly perfect facade.
And here's the first hairline crack. While that headline net interest income number was growing because of sheer volume, the profitability on each individual loan was actually shrinking. Customer spreads compressed by about 41 basis points. Now, in simple terms, that means the margin BBVA makes between its lending rates and its deposit rates got thinner. This is a crucial detail. It suggests that increased competition is forcing them to offer better rates, or maybe that they're chasing growth in less profitable areas. It begs the question, can they really maintain this incredible profitability if their core margins are under pressure? It's like they're running the engine faster and faster just to make up for lower efficiency. How long can that possibly last? This is a clear warning sign of future earnings pressure.
Now let's talk about the cost. Those glorious shareholder payouts, that massive 9.2 billion euros, they weren't free. This slide shows you the price they paid. Before the buyback was accounted for, their CET1 capital ratio, that's the core measure of a bank's financial strength, was at a very robust 13.75%. But after fully accounting for that buyback, it drops all the way down to 12.70%. That is a significant reduction. They are effectively thinning the armor of the fortress in order to hand out more gold. Now, why does this matter? Well, this buffer is what protects a bank and its depositors during a recession or a financial crisis. By choosing shareholder payouts over maximum balance sheet strength, they're making a big bet that the good times will just keep on rolling. And that's a trade-off that makes any forward-looking investor very nervous.
Okay, let's go back to the engine room, Mexico. That incredible 16.2% lending growth came with a hidden cost. And this table, which we pulled directly from their Mexico report, shows it clearly. Provisions for loan losses jumped by 11.5% year over year. This isn't just some boring accounting term. This is the actual money the bank has to set aside because it anticipates that more of its loans will go bad. It's a direct admission that the risk profile of their loan book is increasing. So the crucial point is this. While they were aggressively growing their loan book, the quality of that book appears to be deteriorating. They are lending more, sure, but they are also expecting more defaults. This suggests that the growth is being bought with lower credit standards, which is a classic late-cycle warning sign.
And this isn't just a Mexico problem. Let's zoom out to the entire group, because the risk here is systemic. Total impairments on financial assets, that's the broader category for expected losses, rose by a whopping 15.5% across the whole company. The trend is crystal clear and it is consistent. The aggressive pursuit of growth is leading to a tangible increase in credit risk across the entire organization. The fortress is expanding, yes, but the new territories it's conquering are on much shakier ground. This isn't a small hairline fracture anymore. This is the biggest crack of all, suggesting the foundation itself might not be as solid as those headline numbers suggest. The market sees this, and it understands that today's loan growth can very easily become tomorrow's write-offs.
All right, you've laid out the pressure points very well. The cracks are definitely visible. So now we have the complete blueprint. On one side, we have the fortress, a cash-generating machine with record profits and these massive shareholder returns. On the other side, we have the cracks, compressing margins, a thinning capital buffer, and rising credit risk. It's time to put these two blueprints side by side and render a final verdict. This is the ultimate balancing act of risk versus reward. Let's debate it right here, right now. I see the fortress. I see $10.5 billion in profit and a 19.3% ROTE. In the world of banking, those numbers are absolutely titanic. You simply can't ignore the raw power of that Mexico engine. This is financial reality. But at what cost? You call it a fortress? I see them selling the stones from the wall just to pay for a parade. That CET1 ratio dropping over a full percentage point to fund a buyback is a massive red flag. They are prioritizing today's stock price over tomorrow's resilience. But that's the price of growth. You have to take on some risk to expand your territory. And they're still well capitalized, well above their own targets. They're just being efficient with their capital instead of letting it sit there idle. That $9.2 billion payout is a sign of strength, not weakness. It's a sign of weakness when your customer spreads are compressing by 41 basis points. They're paying out historic amounts of cash at the exact moment their core profitability per loan is declining. The market sees that disconnect. It sees a company trying to distract everyone with huge payouts while the underlying business is facing some very serious headwinds.
So, let's try to distill all of this down into the key takeaways. First, BBVA's earnings power, which is driven by its powerhouse division in Mexico, is absolutely unquestionable. The numbers are real and they are massive. Second, the shareholder returns are enormous, but they come at the direct cost of the balance sheet's capital buffer. It's a very clear trade-off. Third, the company's growth is strong and it is impressive, but it's walking hand in hand with rising risk, as we saw in that significant jump in provisions for bad loans. And finally, and this is probably the most important point, the market's negative reaction, that 7% drop, it tells us that investors are more concerned with the quality and the sustainability of this growth than they are impressed by the record headline numbers. They're questioning the foundation, not just admiring the facade.
Which leaves us with this final provocative question for you to consider. Are BBVA's massive payouts a steel shield, a demonstration of an unshakable balance sheet and a confident outlook that protects investors? Or are they a gilded cage, a beautiful, shiny promise that locks the company into a strategy of prioritizing short-term returns, potentially trapping it and limiting its flexibility and resilience when the next economic storm inevitably hits. The answer to that question will determine whether this is a long-term opportunity or a value trap just waiting to spring. That's what you need to decide. Thanks for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.